Hello my dear student, how are you all? Everyone fine? Once again today we'll discuss the case study scenario for MCQ question. Today we'll take case study number 4 which is also related to mall test paper of May 2025 attempt. Can we start a discussion? Okay sir, let us start. G Limited is a multinational company and prepare and present its financial statement following Indian accounting standard as its securities are listed on a national stock exchange. Okay sir. G Limited has a number of business segments and now they are given some point. Let us read one by one point on which MCQ questions will be based. Point number 1. H Limited is one of the recently acquired Indian subsidiary of G Limited. It has adopted Ind AS for the first time as at 31st March 2004. Means for the financial year 2003-2004 for the first time Ind AS will be applicable. Therefore the date of transition will be the beginning of previous year, that is what from the date of transition will be 1st April 2002, that is only given with 1st April 2002 as the date of transition. As at 31st March 2002 the value of raw material inventories was incorrectly reported due to an error and the amount is significant. So there was some error that need to be rectified. Of course, that need to be rectified in opening Ind AS balance sheet. Now let us read the multiple choice question. Then only we will understand what is the demand of this particular point. Point number 2. G Limited is also engaged in software development. It enters into a contract with a customer to transfer a software license, perform an installation services, and provide unspecified software update and technical support. So you can see there are actually 4 type of goods or services. One is the sale of software license, then performance of installation service, then they have also provided some unspecified software update, and they will provide some technical support also online and telephone for a 2-year period. G Limited sells the license, installation service and technical support separately. Means it is separately available. Means can I say they are capable of being distinct. They are capable of being distinct. Means to understand whether the goods and services whatever provided are single performance obligation or distinct performance obligation. There are 2 points. It must be, means they will be a separate performance obligation if it is capable of being distinct, and they must be distinct within the context of contract. If you remember, the installation service include changing the web screen for each type of user. For example, marketing, inventory management and information technology. The installation service is routinely performed by other entity and does not significantly modify the software. Means the installation services is not modifying the software. It means, can I say, they are distinct within the context of contract, and therefore it will be a separate performance obligation. Understood? Means two or more goods and service will be separate performance obligation if no integration service is provided, no modification or customization is provided, and they are not highly interrelated or interdependent to each other. In this case, can I say the software services does not modify the software, therefore it will be a separate performance obligation. If they are modifying the software, then it will be a single performance obligation. The software remains functional without the update and technical support. Means software can be used without update and technical support. It means, can I say, in this case also the update and technical support will be distinct within the context of contract, because they are not engaged in any integration service. Means they are not providing any integration services. I hope you understood. So there will be 4 performance obligation. Let's see what the question demand. G Limited sells a 20% interest in a wholly owned subsidiary K Limited to outside investor for 100 lakh in cash. The carrying value of K Limited net asset is 300 lakh including goodwill of 65 lakh from the subsidiary's initial acquisition. Now whenever question is silent, whenever question has given full wholly owned subsidiary, it means, can I say, there is a full goodwill. There is a full goodwill, correct? And it is a point of what? It is a concept of changes in the proportion of NCI. So of course we need to find out we need to think about a journal entry. So it is a sale of 20% interest. So what journal entry will do? Bank account debit. 20% interest has been sold at rupees 100. It will change the NCI. NCI will be proportionately changed. So NCI will be what? 20% of 300 lakh including goodwill, and 300 lakh is including goodwill, so that is will be how much? 60, and the difference will be transferred to other equity, so it will be 2 other equity will be how much? 40 lakh. 40 lakh. Understood? Yes sir. Means any difference in this journal entry will be transferred to other equity. Analyze the transaction. Let us read. With respect to H Limited, state whether the error should be reported in the Ind AS financial statement and how to rectify it. Correct? Yes, of course we should rectify it in the opening Ind AS balance sheet. Let's see what the option has been given. H Limited shall report the impact of the error as a correction to the statement of PL for the comparative period. No, it should not be corrected in the comparative period, because the error was in the as on 31st March 2002. So it should be corrected in the opening Ind AS balance sheet only. Understood? Yes sir. Next point, the correction shall be reflected in a reconciliation as at the end of first Ind AS reporting period, that is as at 31st March 2003. So of course, can I say, because it will change, it will affect the retained earning. So of course we need to give reconciliation at the as on the 31st March 2003. But let's see what they want to say in the other option. The impact of correction is significant and it shall be amortized on a rational and systematic basis in the first 2 periods. This is 100% wrong. We never do amortization of that. The first Ind AS financial statement shall distinguish the correction of error from changes in accounting policy. Of course, can I say, we need to distinguish this is not changes in accounting policy, this is correction of error, and reported as a part of reconciliation as on 1st April 2002. Yes, reconciliation in the opening Ind AS balance sheet. We need to provide reconciliation for the opening Ind AS balance sheet. So this option number D is more appropriate. Understood? I hope you have also understood. Even though you don't know, can I say, after observing the option you will get the correct feel. Yes, option number D is more appropriate. Can we go further? How many performance obligations G Limited has with respect to the contract with the customer transfer software license? Already we have understood there are 4 performance obligations, so option number A is correct. I think for this already I have given the what logic behind that. 4 performance obligations, because both the condition has been satisfied, they are capable of being distinct and they are distinct within the context of contract also. Correct? What is the amount of gain on sale of interest in subsidiary K Limited? But it should not be considered a gain on sale, but they have a gain on sale, so we can say gain on sale is 40 lakh. So 40 lakh will be the gain on sale. The journal entry already I have given. Bank account debit to what? To NCI, and the difference will be transferred to other equity. So we normally don't call it gain on sale, but they have asked gain on sale, but that will not be transferred to PL, that will be transferred to other equity. Chalega? Yes sir. Let's see the answer. Answer is given same only. Option number D, option number A, and option number D. Got this? Okay, I hope you have understood. This was small MCQs. I hope you have understood. Next video will meet with what? Case study number 5. Till then, bye bye. Enjoy your remaining day. Bye bye.